Hello, everyone. Ready? We're just gonna jump right in. Today, we're gonna be looking at three different stocks. One of which has been performing really well over the past 3 months. One of which has been not been performing well over the past 3 months, and then one that I believe people should be looking at investing in. So we're just gonna jump right into the stock that has not been performing well over the past 3 months at all, and that is Roku. Um, so just to go look at the stats. Um, well, quick backstory anyways. Roku is it's a company that provides this device that you're able to manage your streaming services all in one place really easily. So you're able to hop on like Netflix, Amazon Prime Video, and Hulu, stuff like that, all in one place. So yeah, just looking at it real quick. First indicator that this is not a stock that has been performing well at all is the PE ratios. Now, what PE ratio is the price per share of a company over the earnings per share of a company, and it's really the ratio that values a company. So the average kind of PE ratio that you want to see is somewhere between 15 to 25, and that number is seen right here. However, this ratio is very industry specific, so that number fluctuates a lot. So you always want the forward PE ratio to be smaller than the trailing PE ratio. And that reason is you always want this denominator increasing because that's the earnings per share of a company. That's the money you're getting back. So you always want that to be increasing, which would make the overall number that appears over here smaller. However, looking at this right here, the trailing PE ratio for Roku is not applicable, which would mean that it was not making money in that time period. Now, looking at the forward PE ratio, you see that it's negative 153.05, which is really bad. It's horrible. So that it means you're obviously losing money per share that you sell. So that's very bad. All right, next indicator is the 50-day moving average and the 200-day moving average. Now, these values act as buffers for the price per share of a company. So this kind of looks at the buffer that resides within the 50-day and then the buffer that resides within the 200-day. Now, you always want the 50-day moving average to be larger than the 200-day moving average because that would obviously show growth over the in recent times. So it would show the growth of the company is doing better than it was than you would say 150 days ago. So right here, obviously, you see that the 200-day moving average is higher than the 50-day moving average, which is not a good indicator at all. So this is kind of what you want to look at when you're trying to see if you should buy or sell a stock. And yeah, that's pretty much it. Moving on, right down here, kind of the management effectiveness area. This is return on assets, the top one. And what return on assets looks at is how much money is generated from each dollar that the company controls. And so it's basically how much money you're making off of the money you already have. And you usually want this number to be, or this percentage to be above 5%. That means that the company is doing well, it's making money, and all is well. However, right here it's down to negative 1.70%, which would mean that it's actually losing money off the money that it already has. So that is not good at all. Going down, return on equity, it's kind of the same idea here, which is basically how much profit a company generates using money from shareholders. So this is now looking at how much the money the company is making from shareholders themselves. And once again, anything above 20% in this case over here, that means the company is doing fantastic. But anywhere below 5%, you want to avoid that stock entirely. And looking right here, it's at negative 7.51. So once again, it's not doing well at all. You're basically looking at, like, for shareholders down here, the return on equity, if it's in the negative, it means you're going to be losing money off of your investment. So that is just not something you want to do at all. So moving on, we're going to be going over and looking at the earnings for the company. So as you see over the past 4 quarters, they have beat their averages. However, as you can see from the first quarter that this data is available to the last quarter, um, their earnings has decreased. It has it did bounce up a little bit in the third quarter, but regardless, it's still going down. Um, the estimate for the third quarter of earnings is, well, it was actually negative. So basically, that means that it was still losing money, and it was estimated to lose about a cent. However, it did not. It only lost like $0.09. So it's still obviously losing money, but it's not losing money as quickly as people assumed it would. So yeah, obviously still an indicator that it's not doing well at all. All right, for the fifth and final kind of idea is the analyst recommendations right here. So you can see these right here. What you're looking for here is kind of the general consensus of what analysts are recommending, and this is basically a 4-2 of people saying not a good idea. You should kind of stick with your position, whether you're in or out, or no, you should sell, versus people that are like, oh, it's been really low, maybe it'll fluctuate upwards and give it a try. So yeah, that's obviously, as you can see, a lot of people are saying hold on your um, position in the stock until it becomes a lot more clear what it's going to do. Some people are saying bow out right now. Some other ones are like, give it a shot. And this is actually very interesting to me to see that people are recommending right now that you should buy. The only idea for that, I would think, is kind of like the buy low, sell high method, because as you can see, that this current average right here for shares is 30.61, and that average is 62.15, showing that it's definitely not doing as hot as everyone assumed it would be. Now, if we go over and look at the chart real quick, just to give you a general idea, at the start of September, or in the middle of September, this stock was trading for around $74.74 a share. Looking down now, the past 3 months, it's decreased about 57%. So it's lost more than half its value in the stock world, showing that it's just been horrible. Especially this stretch right here. This over one day, it dropped about $11 or $13. So yeah, obviously it's not been doing well over the past 3 months whatsoever. Alrighty, the next stock we're going to be looking at is Hershey, and this is the stock that has been actually doing really well over the past 3 months. And it actually took me a really long time to find a stock that actually increased from there exactly 3 months ago. So obviously, 3 months ago, Hershey was trading for 101.7. It looks like if you look up here, and then right now it's trading at 107.33 dollars. So yeah, this took me very long time to find, just because, especially this year has been a very volatile market. We've seen that a lot in the stock market game as well. But yeah, it's surprising that they're doing well, especially in this time. So jumping right in, looking at the trailing PE, the forward PE is lower than the trailing PE, showing that it's expected to earn money continuously. The moving averages, the 200-day is lower than the 50-day. Once again, an indicator that the stock is performing well and will continue to perform well. Return on assets, it's at 15.05%, which is which is obviously above 5%, showing that it's doing well. Return on equity is a massive 97.79%, showing that you're going to be making a lot of money if you invest off of this stock, just because it's been doing well. So shareholders definitely want to get in on this, just because it's been doing well and the company wants to make money off of their shareholders. So they want their investments. So we already looked at the chart, but looking at the earnings, like I said, the first quarter, this we don't have to regard, just because we're only looking at the first 3 quarters, but all 3 quarters it either beat or met its target range. So it kind of jumped way down at the second quarter right here. However, it really regained its value and actually jumped from the first quarter estimates, right, earning estimates right here, and was at the highest one out of the 4 quarters this most recent earnings report. Now looking at the analyst recommendations right here, this isn't that surprising to me that people are kind of not super excited about buying this stock right now. As you can see, though, no one is recommending you sell the stock just because it has been performing well recently over the past 3 months, and it's been relatively sustainable, even though it's had the ups and downs as you saw on the chart. But especially when a stock is doing better than the average, you don't really want to jump in on it just because there is a possibility of it going down, and that's when people would invest and try and use that buy low, sell high method. So I can see why analysts are recommending that you don't jump in right now. However, no one's saying sell. It's looking good. Alrighty, so the final stock that we are going to be looking at today is the stock that I believe you should look at investing in, and that is Amazon. And yeah, so we're going to look at the chart real quick just to see how it's done over the past 3 months so I can give you my explanation. So Amazon at the start of the past 3 months, it was trading for over $2,000 a share, or well, somewhere it's right around $2,000 a share. Right now it's trading at around $1,400. Now, as you can see, Amazon has been steadily decreasing, but it's been jumping up and down, showing that it's trying to make a recovery every now and then. The beta, it's a measure of how volatile a market is. So, sorry, not how volatile a market is, how volatile a stock is. So it starts with 1%, and then if it's above 1%, that means it is pretty volatile. And so being 1.9%. That 0.96 right there shows that Amazon has been pretty volatile. However, if you look right here, the indicators that it is going to increase. The trailing PE is much higher than the forward PE, which is an indicator that the earnings is going to be much higher very soon because it's expected to make more money. So yeah, that's an indicator right there that you definitely want to get in on this stock. If you go down here and you look at the earnings, it's beaten its earnings the past 4 quarters. It's beaten it it's beaten its projections every time. This is the highest projection that it's had over these past 5 quarters, and I'm expecting it to beat it again just because since it's been low, I'm guessing it's going to make a jump. Now, looking at the analyst recommendations, you see everyone is saying they want to jump in on this stock right now because Amazon is such a massive presence in today's stock market. You definitely want to get on this stock, especially right now during the holiday season when a lot of people are going to be utilizing that and getting in on it. I mean, Cyber Monday just passed, Black Friday, everything like that. Like this website will be used a lot. This company is going to go up in price. So a lot of people are saying strong buy. A lot of people are saying buy. And this recommended rating right here is at 1.7. And if you look at the analyst price targets right here, you can see that the average is somewhere around $2,100, and it's sitting at right around $1,500 right here. So you can see that it's doing a lot poorly than it usually does right now. So it's been steadily declining. So it's bound to be looking for an increase very soon. So looking at that, I think you should definitely invest. Alrighty, what's going on, Steve? I just want to say thank you for a great semester in business and finance. I had a lot of fun, and I really enjoyed learning about the stock market and the other topics that we covered. It was very interesting to me, and I'm very excited to take personal finance with you next semester. I hope you have a great holidays, and I'm sorry for my background. I know it's Thanos. I don't know why I have it. It's just funny. But yeah, so I also apologize. It's a little bit longer than 10 minutes, but I thought I had enough information to really round it out. So yes, thank you very much. Enjoy your holidays, and I'll see you next semester.